when we're coming to, I guess, starting a property portfolio, we've started the trustee and the company. Now, what are some of the, I guess, the regulations or rules when it comes to, putting these properties in a trust? Is there a very straight, simple process, or is there a bit of, is a bit tedious?
Look, I think, as in just purchasing a property, you won't have an issue. Consequences are the banks might find it difficult to lend money to a trust that has got no other assets, so they might get your directors to be personal guarantors. If you buy a purchase in a trust cannot distribute a loss. So if you've got a property that's negatively geared through depreciation or interest paid on a loan, the loss cannot be distributed to you personally to reduce your tax bill.
Oh, okay. Yes.
So the trust would only be advantageous if it's positively geared, so that you can distribute the profit to your lower income earners of your family. But if it's negatively geared, you won't get any tax benefit from negative gearing.
So that's good to listen to the viewers if they that's good to understand if the viewers are listening, because look, our methodology, which is cash flow positive, high growth areas, value add.
Yep.
So this wouldn't work for someone that's purchasing a negative gear property. That's probably more suitable being their name, so they can claim those deductions.
Correct.
So what would happen if those deductions, you put a property in a trust and a company, and then you've got those deductions? What happens? Is there going to be a point where you can claim it, or it goes into a positive after a while?
Okay, so if you make a loss, the loss gets rolled over to the following financial year. So if I bought a property in a family trust and it was negatively geared by $5,000, then next year that $5,000 rolls over. And then if the following year I make another loss of $5,000, then the third year I've got $10,000 worth of losses. And then if the next year I make a $7,000 profit, then I don't pay tax on that 7. It gets absorbed by the 10, and that 3 gets rolled over until I'm positive. And then that fourth year, if I make a 10 grand profit, well, I've got 3 grand left, so then I can distribute the 7.
Okay, that's very interesting then. So it's going to always get passed on down the track. So it might not be there, but you might have a big lump sum if it is negative geared in the following years.
Correct. The losses get carried forward, but most people who negatively gear want a instant tax relief. So they usually, if it's negatively geared short term, it's better off in your own name. I mean, look, there's advantages and disadvantages between buying it in your own name and in a trust. The advantage of a trust is when you come to sell the property and you have a capital gain. If it's in a trust, you can distribute the capital gain again to lower income earners of your family members. If it's in your name and you're a high income earner, although you got the benefit of negatively gearing throughout its life, or for as long as it was negatively geared, the capital gains gets thrown straight into your name and you pay tax at the highest rate.